My name is Laura Viriela. I'm the head of BD and strategy at M&NC Group, a multi-strategy fund. I would like to give first a couple minutes to our panelists today to introduce themselves.
Thanks, Laura. My name is Ben Roth. I'm the founder and CIO of Oros, which is a market-making and electronic trading firm. We have 100 people based in Hong Kong, but with offices around the world. We trade over 50 markets, account for 3 to 4% of global crypto volumes every day. And we have actually 10 people here in around the conference. So look for the people with the Oros shirts and go up and say hi. They're very friendly.
Hi, I'm Alex Thorne. I'm head of research at Galaxy. You may have heard of us called Galaxy Digital. And we are a large multi-service financial company in crypto. We have a large asset management business with ETFs and hedge funds. We have a large trading business doing derivatives, OTC, spot, electronic, lending, and a variety of other businesses. And yeah, I run research there. We publish a lot of stuff publicly. Check it out, galaxy.com/research.
Hi, Giovanni Vicioso, Global Head of Cryptocurrency Products for CME Group. We have futures and options on futures on both Bitcoin and Ether. For those of you unfamiliar with CME Group, we are the world's leading derivatives platform, have been helping clients for over 180 years, helping them manage risk. And in December 2017, we introduced Bitcoin futures.
My name is Luc Strijers. I'm the CEO of Deribit. For the ones that don't know us, we are the biggest crypto options exchange out there. We just reached the $1 trillion 12-month trading volume benchmark, of which 2/3 approximately is options. So options is our biggest product, where BTC options dominate the flow. The next one would be ETH. And then we launched linear options about 6 months ago, where we have products like XRP, Solana, and we will be launching BNB options soon.
Awesome. Thank you. All right. I want to start with our stellar topic of the year, which is the ETF. ETF have undoubtedly had the biggest impact for institutional adoption of crypto so far. About 5% of the supply is held by the ETF. In addition to that, of course, we have MicroStrategy with 1%, and other large corporations globally, not only in the US, but also in Europe, in Asia, that are starting to add Bitcoin into their balance sheet, whether that is in the form of the ETF or the physical form of Bitcoin. So what do you believe to be the most important changes that the ETF has brought to Bitcoin or crypto in general? Alex, maybe you want to lead this one?
Sure, yeah, it's obviously a highly accessible institutional grade product, right? An American spot-based commodity trust ETF. I think the Bitcoin ones have been wildly successful. We've already seen some top allocators, pensions, right? The state of Wisconsin Investment Board is one of the most notable that own directional exposure to Bitcoin through the ETFs. I think the audience probably knows all of the high-level reasons why. These are they're great products aside from crypto. ETFs are extremely easy for everybody to use. I think what we're waiting for further adoption is for the Bitcoin ETFs to get put into model portfolios at the wirehouses, for there to be some incentive for advisors to actually look at putting them in there. We also want options on the ETFs, which basically every other ETF has, inexplicably not available yet in the US. One of the interesting things that I have been saying about the ETFs and that we thought would be true was that their existence will, of course, I think, dampen volatility over time. The products are made for financial advisors. We can all already buy Bitcoin pretty easily, but an advisor can't easily put 500 client portfolios into a Bitcoin allocation. It will dampen the volatility in a way that if you buy Bitcoin on Binance, it's very easy for you to sell it and buy ETH and then sell that and buy the next thing. And this will also create a less cyclical environment in the market, I think, where and we're seeing that in this market, which has been mostly Bitcoin driven. So I think the historical cycles of crypto price action will also be dampened because of these products.
And some people are concerned about the concentration that the ETF are holding on the Bitcoin side. Is that something that any of you is concerned about, or what would you tell the audience?
Okay, I think when you look at ETFs, right, to just further Alex's point, it's really drawn in additional participants to the space. So participants that may have been, say, crypto curious, but couldn't trade on spot exchanges or some of the other available products, they're now in the space. And those products have been extremely successful, perhaps the most successful ETFs launched. So we see those products now driving volumes really across the ecosystem, right? When we launched Bitcoin futures back in December 2017, we designed that contract with the expectation that ETFs would be around the corner, maybe 6 months at most. But it would take 4 years for the futures-based ETF that ProShares pioneered, and then almost 6 years for the very successful spot products to come. But when we look at volumes, just comparing our average daily volume this year to last year, we've seen volumes more than double as a result of liquidity provider, authorized participant activity, really leaning on the liquidity of our futures contracts to provide liquidity for those ETFs. And also like to point out that in the case of the futures-based products, all those products have to hold, and there's over a dozen of those ETFs. All those firms have to hold CME futures contracts. So that's helping to drive record open interest. Since November of last year, we are the leading marketplace for Bitcoin open interest. And that's even when compared to some of the unregulated platforms, including, say, the so-called perpetual swaps, right? And in the case of the spot products, more than half of those products are benchmarked to CME and crypto facilities, now CF benchmarks, reference rates in both Bitcoin and Ether, products that we helped develop with crypto facilities back in 2015, just really providing the marketplace with an identifiable single point of reference for the price of Bitcoin. And we're really seeing those products becoming the benchmark.
I got a slightly different take. I agree with what you guys have said. It's really these products have really spurred a kind of new wave of adoption through the institutional landscape. To some level, I find it somewhat concerning that it's taken a new wrapper for institutions to actually get involved, given that crypto as a kind of asset class is defined by self-custody and non-kind of gatekeeper environment. It's taken this kind of familiar wrapper that people are used to actually get into an asset class that was designed to avoid that type of wrapper. And I'm wondering what you guys actually think. I'm going to take the role of moderator at this point. I'd actually be interested of what you guys think it's going to take for these types of users to get involved in the physical and the actual industry, as opposed to just purchasing a wrapper around the asset class.
I think from our perspective, the answer to your question is access. So of course it's sad in a way that this is needed. On the other hand, if you see the daily operations we're engaged in and the differences in on-chain recons, audits, all of that stuff, if you then imagine all the investment banks converting to that new type of behavior, systems, all of that, it will take ages. So yes, it's sad, but it's necessary. It's paving the way to adoption, perhaps a few years from now, perhaps 10 years. So that's the way we see the ETF as well. It's just access. And now there's hundreds of billions in the ETF. And step 2 is derivatives. It's efficient access. It's capital efficient access. It's hedging for events. It's elections coming up, macro themes, rate cuts, all of that has an impact on prices and can be addressed using options, using futures, using something. But without the ETF as step 1, step 2 will never be executed. So in the end, all of us here in the room expect this to happen, and this is just step one. There's much more to come, which will benefit everyone.
Yeah, I agree with that take. The best way to own Bitcoin is obviously to hold your own keys, right? The owners of the ETFs, they can't send Bitcoin over the Bitcoin network. Take the Ethereum ETFs, even a starker delta between the utility of real Ethereum and Ether in an ETF, right? Can't do DeFi with your ETH ETF shares, can't stake it and earn yield. So it's obviously better to actually hold crypto directly, hold Bitcoin directly. Some of my most diehard Bitcoin friends, very concerned, to your question, Laura, about the concentration risk. Oh my gosh, BlackRock owns all this Bitcoin now, or their clients do. Obviously, like on a first orders basis, the ETF, Bitcoin is not a proof of stake chain. So the amount of Bitcoin that you own grants you exactly zero direct control over the chain. But of course, you know, in the case of a contentious hard fork or something like that, the economic power of the chain can influence what happens to it. But I take a very optimistic view, kind of like Luke is describing here, which is if we talk just about Bitcoin, if Bitcoin is going to become globally adopted money or a digital gold, it's going to be in every type of account that you can imagine. You're going to have Bitcoin in your checking account and on your fintech app and in your money market funds and your ETFs, right? So to me, this is actually what hyper-Bitcoinization looks like. This is what winning looks like. But you know, we absolutely push a narrative and try to explain through education why actually holding the actual thing is best.
It's stickier, right? Yeah. Like once people actually embrace the industry and embrace the technology, then it's stickier capital and stickier users than just people purchasing a ticker symbol, right?
And most of those entities, the banks or even the fintechs or the wirehouses, they can't actually use it yet. In the US, banks are largely prohibited from touching crypto directly, right? So I think once they can, then you can go into your brokerage account or your managed account at your bank, and they can have Bitcoin allocated in your account, but actually it is Bitcoin, and if you were to need them to send you the Bitcoin out of your account, they could, right? Or if we get redemptions in kind from the ETF, same thing. If you could move it in and out of the ETF, that'd be great. I think you want to preserve that option for self-custody and direct ownership, but I don't think it's like a requirement for every person, and certainly not for every institution.
But I think it also depends on where you are. 'Cause I think when you look at developed markets and ETFs just become another access product, right? But the entity that's taking that exposure is doing more so for an investment, right? But when you look at different jurisdictions, you look at places like Latin America, Central Republic of Africa, other places where they actually see a use case for Bitcoin. There, I think it might make more sense for those individuals to hold Bitcoin. But I think in developed countries, it's more, I'm looking at this more as an investment, and I'm comfortable with getting that exposure through an ETF, right?
So when we talk about OTFs, it's pretty much more from a US perspective, or the institutions that we think about it, it's mostly from a US perspective. We're in Asia now. Asia has a really big role to play also in crypto. Where are Asian institutions in the process of adoption, and who are the Asian institutions?
So, we see, Hong Kong as, I think, led the APAC region in terms of ETFs, and now there are ETFs on both Bitcoin and Ether, both futures-based and spot-based as well. I think there's about 10 or a dozen different ETFs with 5 different ETF providers providing access to these products. The majority, actually all of those products are benchmarked to the CME, CF reference rates, both Bitcoin and Ether. And we're really seeing in region, I think that the ETF market in Hong Kong compared to the US markets, it's still relatively small. But I think in general, ETFs in region are small relative to other global ETFs. But we do see activity coming from the APAC region. In fact, about 40% of a day's futures volume is traded before 9 a.m. New York time, right? So really signaling that there's strong activity during extended trading hours. We probably have about 11% of our volume coming out of APAC, and that's an uptick from where we were last year. And I think really to further highlight the interest in the region, you know, we take a look at the activity on August 5th this year, right? Right around when the Bank of Japan increased rates, there was an unwind of the cash and carry trade. You know, that morning between 9 to 10 a.m. Singapore time, we traded close to 70,000 contracts in that hour. So close to 2 billion in terms of notional. Typically in that hour, we trade less than 2,000 contracts. So we really saw a 35x increase in that hour, and represented, say, 14% of overall volume. And regular trading hours in Singapore, so looking at 9 a.m. to 4 p.m. local time, we probably traded over 36% that day. So really highlighting that market participants knew where to go to access liquidity, right? So they really turned to our trusted, reliable market for that.
Look, I'm curious, from a Deribit's perspective, how has the Asian user base changed since you guys launched more than 8 years ago?
I think we've always been quite significant in Asia, and we still are. So if you look at from an hour perspective, we trade most when volatility is highest. Mm-hmm. Typically, volatility is driven by whatever news and macro events where the US dominates. So hour-wise, US pre-open is on average our highest volume slot. However, if you look where the volume is coming from, a significant part comes from Asia. So it's not traded by people in the same time zone, it's people trading 12 hours away. So a lot of it is automated. Of course, volatility, HFT, all of that stuff trades by systems and not by people pressing a button, so it doesn't really matter that much. If you look at where the flow is coming from in terms of unique users, active users on a monthly basis, or AUM, assets deployed with us, a lot of it is coming from Asia. And where we see growth, especially this year, is family offices. So it's either directly trading on Deribit, or it's them allocating assets via so-called SMAs, these segregated managed accounts. So it's simply an office allocating assets to someone else via API keys, but then keeping the assets with us. So in the family office's account with Deribit, they create a sub-account, allocate, let's say, $10 million, which is traded by someone else without leaving the account. And we see some decent growth there. So I expect quite a lot from it, because those family offices don't have to hire specialists. They can simply allocate capital to someone else without actually moving the capital. Mm-hmm. The next step is more efficiency there. We can do invoicing, we can do a lot of things, reporting on behalf of those managers that we currently don't do. So I expect the market to evolve there. But if you look at individual traders, hedge funds, family offices, there's quite a decent growth here. And Hong Kong is leading, and I think Singapore would be next.
Mm-hmm.
Yeah, we've seen an uplift in probably participation activity through Asia, whereas previously it was focused predominantly on hedging, and probably in the last 6 months we've seen a lot more appetite to take some upside and to take some more participation exposure into the industry out of our Asian client base. Probably wouldn't classify them as institutions in the same way that you would, Giovanni, but I'd say non-retail participants have taken more of an upside participation.
Now, moving on to credit markets, the collapse of the big credit providers from last cycle, like Genesis and Celsius, has left a gap that hasn't really been covered yet. Are prime brokerage stepping in to cover that gap now, or what's going on?
Yeah, I'll speak to that, because we're seeing a lot of this. So it was super noticeable. So the market structure has changed quite considerably from an intermediation model back in 21, 22, where you had large lenders like Genesis and BlockFi and Celsius kind of intermediating retail capital with institutional use. So we were major borrowers from all of these lenders, as were most market makers and trading firms. And even still, leverage was relatively modest on most balance sheets. They say 3 or 4 to 1. that leverage has almost practically disappeared from most balance sheets. The only way to get leverage now is through private deals, via exchanges, or through some uncollateralized or sub-collateralized borrow, which most of the lenders these days don't offer. It's probably the one major thing missing in the industry, I would say, is effective leverage so that market makers and liquidity providers can efficiently cycle capital around different venues and create liquidity and efficiency. There are some, I guess, some ideas being floated where you have like pooled capital vehicles, and exchanges can kind of look into those pooled capital vehicles, and we can kind of attain leverage that way. But it still remains probably one of the most inefficient and capital hungry asset classes out there, and it's really the lending market that's going to solve that. We've got some stuff on chain. With restaking and with liquid staking vehicles where you can rehypothecate and reuse different versions of collateral, but the actual base lending market still hasn't come back and isn't really showing signs of coming back above and beyond fully collateralized, which I think you guys are quite active in.
Yeah, I mean, the lending market absolutely is maybe 1/30th of what it was in 2022. It's absolutely tiny compared to where we were. I've just been talking with this group before. We're doing some research on this exact question. How big was it and how big is it? And I mean, we were looking at 20 to 30 billion in total aggregate open loan book, loan book size across all of these, the Genesis, BlockFi, Celsius, Galaxy, Coinbase, whoever else. And that's a lot less liquidity in the system. One of the things that I've been wondering, because at the same time, since I think the peak was Q1 22. The options markets have absolutely grown enormously since then. And I know from some of our counterparties who used to hedge or gain leverage by interacting with the lending desks, they've now adopted more options trading strategies to do the same. That's one of the outcomes I've seen. But we're not close to getting back to that level of liquidity that we had then. You are starting to see some traditionals like Goldman Sachs and Cantor Fitzgerald enter the over-collateralized crypto lending space a little bit, but not quite nearly at the levels that we
and that's not providing leverage to the system, right? That's just swapping one asset for another.
I mean, something that we noticed around the collapse of some of those firms, particularly after FTX, is that you're absolutely right that the lending borrow market just absolutely collapsed. So we started to see anybody really that wanted to establish that short position really came to our market, right, where there's no borrow needed. You simply just sell a futures contract and you're short. So we really started seeing more market participants coming, say, to our regulated market. We saw our futures market go into backwardation as a result, because anybody that wanted to go short was essentially selling futures, so driving our contracts into backwardation. But fast forward to what we're seeing now, right, and going back to the topic about the ETFs. ETFs are available now. The futures-based ETFs can be loaned. The spot products, can also be loaned. So I think that that's also helping to fill a little bit of that gap. And certainly we see our market now back into contango. So the situation where subsequent futures contracts trade at a slightly higher price than nearer term contracts. But our market is now about the same levels in terms of contango where we were, say, prior to the collapse of the various lending platforms.
I think what we see is the firms like Hidden Road, FalconX, etc., stepping in quite sizably. So they provide credit and they do quite well. So and we encourage that. So all of them trade on multiple platforms, and the onboarding is easier and easier. So they get volume discounts, but on this, they would also provide more efficient capital access to, let's say, CME versus Deribit. So if you trade on Deribit, let's say you open a 100 million position, you need a certain amount of capital as margins. These firms like Hidden Road, FalconX, etc., they will provide the credit, let's say the 20 million needed for the CME position. So using the BTCs deployed with us in their accounts as collateral. So it opens the door to trades that were previously perhaps provided by capital provided by the desks. Those desks are gone, and it's partially compensated in this way. I think there's also part of it is simply solved bilaterally, two firms trading with each other. I think the discussion topic is that kind of stuff is evolving more frequently, but I think a lot of the crypto native firms are not familiar with ISDA, so these negotiations take ages. And in the meantime, they try and use us as an offsetting venue. But I think over time, and especially when it comes to different products, some options position that expires 1 year from now that we don't trade. Currently, margin-wise, it's inefficient. Some of it is like 100% collateralized. So these type of trades, I think, will evolve in a more efficient setup over time. Either ISDA, either platforms, either firms like Galaxy, perhaps CME will step in. But I think the conclusion that all of those desks are gone and that billions of dollars are gone is incorrect. I think on a net basis, a lot of it is gone, difficult to quantify, but it has been replaced by bilateral and primes.
Mm-hmm. Now, we've seen a bit of this year, basically, a lot of the hedge funds have underperformed Bitcoin. Could this be related to some extent to this lack of credit, or why is it also that the rest of the market hasn't picked up yet? Any thoughts?
I think it's the same structure as traditional markets. Most hedge funds perform the index. I guess if you said Bitcoin is the index, if we want to use that as a proxy, most hedge funds don't have alpha. They are just beta plus fees. So it's not surprising that most of them have underperformed. The other thing is that Bitcoin's probably the best performing crypto, well, certainly major crypto of the last 6 to 12 months. There's probably as a result of the ETF, as a result of it being the logical entry point for large amounts of capital. What will be interesting is if you see a more broad-based rally over the next, say, year or two, will that kind of same trend continue? I would say that hedge funds will probably underperform the broad market, but perhaps might outperform Bitcoin if you see a broad market rally elsewhere and a lot more activity.
Yeah, I mean, I agree with that wholeheartedly. We run a database called Vision Track at Galaxy that tracks 300 plus crypto-focused hedge funds, fundamental, long, short, quant strategies. None of the strategies have outperformed Bitcoin this year. Historically, over longer time periods, they have, right? I mean, but it's been tricky, I think, for, I mean, I had an analyst look into this yesterday, literally how many coins did outperform Bitcoin. We'll look at all 14,000 on CoinGecko. They found 48 that did, right? And I mean, none of them are in the top 25, right? So it's tricky if you're trying to get alpha over Bitcoin. This is what I was referring to at the beginning about the cyclicality. Prior bull markets, historically speaking, you would have seen the rally move down the risk curve here in crypto, and you just haven't seen that yet. And most of them, right, if you're committing money to a crypto hedge fund, you may already own Bitcoin. You're looking for the rest of the stuff. You don't know what to do. You don't have time to investigate those 14,000 coins. You're hoping the manager can do that. So the managers are largely trying to outperform Bitcoin, and this has been one of the toughest years to do that.
It's probably because most of the new flows, it tells you where the new flows are coming from, right? It's not coming from retail chasing beta, it's coming from institutions and more conservative capital coming in and just trying to get exposure to the lead asset.
But I think it also depends on, say, the type of hedge fund, right? Because if you're talking about some of the crypto-focused funds, I think that some of those funds, may have the appetite, the ability to say trade spot. But when you look at some of the more traditional hedge funds, they may not have that access, right? So a very popular trade that we see with some of those larger macro hedge funds is the cash and carry trade, right? And we've seen that, ahead of the ETF announcement and subsequent launch. That basis essentially was running at around 20% or so, and now it's hovering in the 7 to 10%, but it still remains a very popular trade. When you look at the 13F filings for the various Bitcoin ETFs, you'll see that there's still some very prominent large hedge funds there, And my guess is that they're not just long the ETF, right?
Yep.
This is why it makes sense for there to be a credit market in crypto, because even if you go back to uncollateralized credit, there are some credits in crypto that are probably, would be rated triple B or double B, and there'd be a price for that. And there is excess returns because there is a shortage of dollars, and that's where the carry trade comes from. If it's trading at 15%, what it's saying is there's more people that want exposure to Bitcoin than there are dollars in the system. And so if you want that leveraged exposure, you're paying an implied rate of 15%.
But when it was trading at 15-20% for BTC, ETH was also generating similar yield. And if you look at today, it's whatever, 7, 8, 9, 10. But the level of interest in ETH has dropped significantly. So if you look at our open interest or volumes or whatever, at some point the ETH merge and those storylines, they were approximately identical. Not perhaps BTC slightly more, but it was almost comparable. And everyone was talking, of course, about perhaps the flippening and those kind of angles, ETH overtaking BTC. That's completely gone today. BTC is twice or more the size of ETH in open interest in volumes in overall narrative. No one is chasing ETH or positioning for massive upside today. While for BTC, with war, with rate hikes, with elections, it's about the ETH macro story and the hedge against all of those stories. And ETH is nowhere to be found. So I'm not surprised that in terms of rankings and performance of hedge funds, I think a lot of people are surprised. So the ETH allocation most likely has been way too high for all of those performances versus BTC.
Yeah, lots of votes there that didn't happen. Actually, does anyone have any strong opinion on why the interest on ETH, not only from like open interest, but in general, why it's gone down so much over the past few months or the year in general?
Yeah, I mean, I have a lot of thoughts about that. I would say,
I thought so.
Look, there's a couple things. On the one hand, if you were thinking that Ethereum could be ultrasound money, that it inherently is not a strong argument when no one can tell you what the inflation rate will be at any given time. Like, I mean, Bitcoin, I think people realize that that was a silly argument for Ethereum just generally. So it's not going to be a better digital gold than Bitcoin. On the other hand, it's a platform for running applications. It's facing unprecedented competition from Solana. There absolutely was not a viable contender in 2021 or 2017 to compete with Ethereum for the generalized smart contract blockchain use cases. And it's almost a victim of its own success. The layer 2 networks, which are absolutely very successful, I think they're dilutive rather than accretive to ETH USD at the moment. And then lastly, probably the biggest reason is if you think of Ethereum as a platform for developing applications, which is how I prefer to think of it, all of that application categories that drove all this interest and demand from 21 and 22 are just down horribly, right? Like, when was the last time anyone on the stage heard the term metaverse, right? NFTs, they're here to stay, but go look at trade volumes. They're a fraction of what they once were. Gaming, those are high cost, long lead time products to build, high quality video games. There isn't one still that is, like a breakout hit. So, tokenization, it's back. I remember it was a huge deal in 2016, but it's still not really here, right? You've got some real world asset stuff, but so the narratives are also stagnant or even decaying that drove so much interest in Ethereum then as well. So it's a combination of those in my opinion.
It's more of a BTC story, right? Like, yeah. It's not so much negative ETH or negative Solana. It's more just there's no natural narrative to drive a lot of capital inflows for those coins. But BTC has an obvious catalyst and an obvious narrative, and so that's where all the capital's flowing. And the rest of it is kind of just a little bit stagnant at the moment. At some stage, that capital, now that it's in the industry, will likely flow to the higher beta and higher risk areas of the industry. But at the moment, everybody coming into the industry is just chasing BTC and the narrative because it is very compelling.
Mm-hmm. And I think it's like with Bitcoin, you have more of a defined use case where there's a lot of talk. It's a store of value. It could be a payment network. But with Ether, it's like, and to your point, there just really hasn't been that killer app that people can wrap themselves around, right? So whereas we thought that sometime this year it would be Ether's turn, it seems to be Bitcoin's turn all over again, right?
It's just a very easily digestible narrative and use case. Yeah.
Yeah, I mean, there are, the one category I didn't mention that's quite durable is DeFi. It's widely used. But it's not, this isn't the summer of 2020 DeFi summer when that enthusiasm was actually driving capital onto the chain. To me, I look at DeFi today as extremely useful for on-chain wealth, and we use it. At Galaxy, we're involved in DeFi markets, but you don't have like exogenous wealth moving on-chain to use these tools. It's more about the people that already have wealth on-chain that need access to tools. So it's not growing at the moment, right? And so the other one is stablecoins. They're great, but again, they don't really drive. They're certainly not an Ethereum-only story. And if you think about the growth in payments with stablecoins, that's mostly not happening on ETH layer 1 either. So yeah, I'm confident this will come back, but I think there was we're almost in a hangover from the drunken exuberance of the 21 and 22 when it comes to like crypto and Web3 narratives.
Yeah, touching on Cookie with our last topic, one of the biggest advancements, I guess, that we have from the previous cycle has been a bigger push towards off-exchange custody. Where are we on the process? Are there already a lot of institutions embracing that, or are they waiting for a bit more development?
For us, it's one of the biggest agenda items for this year. So we offer off-exchange access via Copper, via Cobol, via Fireblocks, via FalconX. We've announced to implement Zodia next. And going forward, I think the next for us on the roadmap would be Signum, BEC, BitGo, Komainu. For us, in the end, starting with the ETF story, it's about access. So people want access either via an ETF, but they also want access via a custodian they trust, which could be a US custodian with the QC status. Some others want an Asian custodian. Some others want, whatever, a Swiss custodian. For us, we want there to be zero reason not to trade Deribit. That could be regulatory-wise, that could be trading products, but it's also custody-wise. So off-exchange custody, I think, for us, so we hold approximately, let's say 88, 89% of the assets directly. So 11%, 12% is currently off-exchange. I think 6 months from now it will be 20, 30%. I think it would really go rapidly because the institutions will be able, if the custodian has the stamps needed for that particular region, they will allocate more. Instead of 100 million directly with us, they could do 200 million, which will generate higher trading volume. So I think for a lot of exchanges, but I think we're spearheading that, so we already have more choice than anyone else. We will double that choice in the coming year. So it's like a key pillar for growth for us. And not only the current existing products, but also expanding products. Treasuries, whatever, dollars. You don't have to hold dollars with us or treasuries with us, but you can hold it with any of these custodians.
Awesome. And then we only have 25 seconds left, but a quick spit round. Next 5 years, where do you think the market cap of digital assets will be at, and what are the 3 top tokens and stablecoins can be included in this top 3?
5 trillion, BTC, ETH, Tether.
I'll go with 7 trillion BTC, Solana, Tether.
Like I can't speculate, but I do know one thing for sure, that our products will be there to help you guys hedge those different tokens.
I think BTC, ETH, and any of the stablecoins. So I think the fight will be interesting to see. So I'm not sure who's going to win, but I think it will be massively bigger than it is today.
Awesome. Thank you very much.